David Plank, thanks so much for joining us here on the program. RBA hiking rates by another 50 basis points, very much expected.
Yes.
But what did you take out of the statement? A little more dovish.
Yeah, there was an important change. I mean, they kept the bit at the top where they talk about keeping the economy on an even keel. That was important. But then at the end, they removed the reference to looking further steps to normalising or policy. And by removing that statement, normalising, I think they're opening up the possibility that in sort of the October-November meetings, they'll be actively discussing whether they go 25 or 50. They've still got more to do. They talk about we've got further steps over coming months. So they're not stopping at 2.35 or 2.6. I think they're going above 3. But now I think they're opening the door to at least actively debating whether the next moves are 25 or 50.
Economic data is obviously key. We know inflation, they're an inflation-mandated bank, is the key data point we're watching. But what else do you think is in their line of sight over the next couple of months, data-wise?
Well, there's a new paragraph where they focus a bit more on wages. So wages is important, but we don't really get any important wage data till November. So it'll all be the anecdotes and other stories. But wages are important. But the labour market's really important. We think the unemployment rate is going below 3%, which is great news, but that'll keep the pressure on the RBA to keep hiking. And then consumer spending. What happens to consumer spending? Everyone's
talking about this sort of fixed rate cliff and when the rate hikes actually start flowing through to consumers and the hip pockets.
Yes.
When is that expected to happen? And you know, could it hit quite hard?
Well, I think the cash flow impact's flowing through now. There's been some analysis that suggests it might take 3 months. I think it's a bit quicker than that. But people know what's happened to interest rates. It's not like people don't know it's not coming. So, you know, I think people are sensible and they make rational decisions for the most part. In terms of the lift in those people on fixed rate mortgages, the bulk of those really start to happen around the middle of next year.
Yeah.
So again, they've got a lot of time to prepare for that. So it's not going to come as a surprise. They're going to know what's going to happen, and I think they'll be well prepared when those increases do come through.
Confidence numbers. I know there was data released today, obviously, I think the highest level since June, but it is still quite low. What do you take out of that data point?
Yeah, no, it's better, but it's not great. In fact, it's still pretty terrible, actually. Yeah. Consumer confidence is still at exceptionally low levels. It's better for people's own finances. People are more confident about their own finances, which I think goes to the strength of the labour market, but they're worried about the cost of living, rising interest rates. Those things are impacting. The key thing, though, of course, is that confidence hasn't been a good indicator for what people have actually been doing. People have been spending. Consumer spending has been strong. It is slowing. ANZ data suggests that spending is starting to slow, but I still think growth is reasonable, and I think it's really about the fact that people have got jobs that really matters.
And that's the interesting part, right? Because we're seeing rate hikes around the globe and labour markets are holding up everywhere. Yes. So what do you think will be the catalyst to see that start to come back?
Well, we've got to get growth below trend for the labour market start to slow, and growth is still above trend. When we see the GDP data tomorrow, we're looking for 0.8, 0.9 for the quarter. If you annualise that, that's a number above 3. That's above trend. Trend growth in Australia is in the low 2s at best, given very low population growth at the moment. So anything above 3 is well above trend. We need to slow growth below trend to restore a better balance between demand and supply.